Welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today, July 21st, 2025, we're dissecting the recent tumultuous movements of the USDCHF pair, looking at both breaking news and the raw chart data. Recent headlines are painting a clear picture. Broad-based US dollar weakness is a dominant theme. FX Street reports USDCHF retreating towards the crucial 0.8000 level, while tariff uncertainty also pushed the pair below 0.8050. Investing.com highlights UBS lowering Swiss franc forecasts, yet the CHF has shown remarkable resilience and maintained strength for most of the year, despite reduced SNB intervention. A major driver for this is the diverging policy outlook between the Swiss National Bank and the Federal Reserve, with heightened expectations for Fed rate cuts due to U.S. inflation and labor market weakness. Action Forex previously noted that USDCHF recovered to 0.8063 but failed to sustain above 0.8054, which turned into resistance, indicating a bearish lean. Trading Economics confirms this sentiment, reporting that the USDCHF exchange rate fell to 0.8011 on July 18, 2025, and the Swiss franc has strengthened nearly 2% over the past month. Perplexity further emphasizes this, noting a significant plunge below 0.8110 due to these rate cut expectations and safe haven flows into the CHF. Now, let's translate this news into what we see on the daily chart. Looking at the full range of daily candles from March 2024 to present, the long-term trend for USDCHF has been distinctly bearish. We can observe a clear series of lower highs and lower lows, indicating strong downward momentum. The pair traded in the 0.87 to 0.91 range for much of early 2024, but a significant downtrend initiated around April-May 2024. A substantial bearish move occurred in June-July 2024, pushing the price from above 0.91 down to approximately 0.84. Following a period of consolidation around 0.84 to 0.87 in late 2024, another major leg down began in 2025. This aligns perfectly with the news of increased expectations for Fed rate cuts, making the US dollar less attractive. The Swiss franc, acting as a safe haven currency amid global uncertainties and diverging central bank policies, has found continuous demand. This long-term perspective clearly illustrates the underlying strength of the CHF against the USD. Let's narrow our focus to the period from April 1, 2025 to April 30, 2025 to highlight a critical bearish development. As you can see, during this period, USDCHF experienced a dramatic crash. The price plunged from highs near 0.88 to a low of 0.8097, effectively breaking below the psychologically important 0.8110 level mentioned in our news review. This sharp decline confirms the market's aggressive reaction to the growing expectations of Federal Reserve rate cuts. The momentum during this month was overwhelmingly bearish, with consistent selling pressure driving the price through multiple previous support zones. This powerful move demonstrated the market's conviction in the Swiss franc's safe haven appeal and the US dollar's weakening stance. This region marks a pivotal breakdown point in the broader downtrend. Shifting to the 1-hour chart, let's examine the more recent, although not the very latest, price action available to us, focusing on the period from June 30th to July 3rd, 2025. This chart shows a short-term downtrend from roughly 0.798 to below 0.793, indicating continued bearish sentiment on an hourly scale. You can see prices testing and breaking temporary support levels. On July 1st, we observed a dip to a low around 0.787, which is a significant level we'll discuss further as potential strong support. Towards the end of this hourly data, specifically around 12 o'clock Universal Time coordinated on July 3rd, there was a noticeable spike. The price briefly surged from 0.793 up to 0.798, followed by a pullback. This could signify some short-term volatility or a fleeting attempt by buyers to push back, but it was quickly met with selling pressure, unable to sustain the gains. This reaffirms the underlying bearish bias even in shorter timeframes during this period. Moving to the 15-minute chart, which provides the most current data, we can observe the immediate price dynamics from July 15th to July 20th, 2025. On July 16th, the price generally hovered around the 0.801 to 0.802 range, showing some consolidation. However, a notable sharp drop occurred on July 16th, around 15:09 Universal Time Coordinated, where USDCHF fell from 0.805 to 0.798. This sudden move reinforces the strong bearish pressure that can emerge quickly in this pair. Following this, on July 18th from 0:09 Universal Time Coordinated, after a brief consolidation around 0.802 to 0.803, the price resumed its descent. It dropped further, reaching levels very close to the critical 0.8000 psychological support by 11:54 Universal Time Coordinated. Currently, as of July 20th, the pair is trading just above 0.8010, confirming the news that the Swiss franc is indeed flirting with the 0.80000 level. The consistent lower highs and subtle lower lows on this short time frame demonstrate that sellers remain in control. This close proximity to 0.8000 suggests that a test of this key psychological level is imminent. So, what are the reasons to be bullish or bearish on USDCHF? For a bearish outlook, the strongest argument is the overwhelming long-term downtrend, reinforced by the recent major breakdowns below 0.8110 and a push towards 0.8000. The fundamental drivers, particularly anticipated Fed rate cuts and the CHF's safe haven status, continue to favor Swiss franc strength. The repeated failure to hold above previous resistance levels, like 0.8054 further, indicates bearish dominance. From a technical standpoint, the consistent series of lower highs and lower lows across multiple timeframes signals continued downward pressure. Reasons to be bullish, especially in the short term, are primarily defensive. The 0.8000 level is a strong psychological support, and a bounce from here is possible, though its sustainability is questionable given the macro backdrop. We saw a small bounce after the July 1st dip on the hourly chart, and similar reactions might occur around 0.8000. However, any significant bullish reversal would require a fundamental shift in central bank policies or global risk sentiment. For traders, consider short positions on rallies towards immediate resistance levels like 0.8050 to 0.8054, with targets at 0.8000 and potentially 0.7950. A sustained break below 0.8000 could open the path to the historical low of 0.787 from the daily chart, which presents a strong long-term target for bears. Conversely, if 0.8000 holds, look for consolidation or a bounce towards 0.8020 to 0.8050, but be cautious of quick reversals. The likelihood of a continued bearish trend is high, perhaps 70 to 80%, unless there's a surprise hawkish pivot from the Fed or a major shift in global risk appetite that weakens the CHF. A strong rebound above 0.8110 would be necessary to negate the immediate bearish bias, but this seems unlikely in the short to medium term. Continue to monitor U.S. economic data, especially inflation and labor market reports, for any shifts in Fed expectations. Also, keep an eye on broader market sentiment, as global risk-off events could further boost the safe haven Swiss franc. The 0.8000 level remains the immediate key price point to watch for breakout or rebound opportunities.